This story isn't about a chart pattern or a bad trade or a market cycle. It's about something much rarer and much more dangerous. It's about what happens when an entire industry discovers in real time that the thing it trusted most was built on air. Because in November of 2022, crypto didn't just drop. Trust vanished overnight, and once that happened, price was the easy part. To understand why the collapse hit so hard, you have to remember what one of the world's largest crypto exchanges represented right before it fell. It wasn't a fringe platform living in the shadows. It was everywhere, on arenas, on jerseys, in interviews, in glossy headlines that treated it like the grown-up version of crypto, the safe one, the responsible one, the one that would survive when the rest of the industry got reckless. It had leadership that was presented as a new kind of tech elite, unpolished, quirky, almost allergic to flash. They talked about regulation as if it was inevitable. They spoke the language of risk controls and compliance. And they cultivated an image that made people believe the exchange was not only big, but legitimate. When an industry is built on volatility, legitimacy becomes its most valuable product. Traders didn't just deposit money, they deposited relief. Because for years, crypto had been a landscape of hacked platforms, anonymous teams, rug pulls, and exchanges that felt like they were one bad day away from vanishing. This one felt different. And that feeling mattered more than most people realized. By 2021 and into 2022, the exchange had become a central piece of crypto's infrastructure. It wasn't just a place to trade spot markets, it was a major derivatives venue. It was a source of liquidity. It was a brand that institutional money could point to without flinching. And in the background, the market was already tired. Crypto had taken brutal hits earlier in 2022. Big names had failed. Big promises had collapsed. Leverage had been exposed as a hidden poison. Trust, already fragile, was operating on a thinner and thinner margin. Which is why the next shock didn't need to be huge. It only needed to be credible. And it arrived in the form of a document. Early November, a report circulated describing the balance sheet of a proprietary trading firm closely tied to the exchange. On paper, it looked like that firm's financial strength was heavily dependent on a token issued by the exchange itself. For most people outside markets, that sounds abstract. Inside markets, it sounds like a fire alarm. Because the moment traders hear that a firm's stability depends on a token that can be crushed by selling pressure, the mind immediately jumps to the same question. What happens if confidence breaks? And in crypto, confidence doesn't break slowly, it breaks like glass. At first, it was a conversation. Then it became a rumor. Then it became a thread. Then it became 1,000 threads. Traders began asking uncomfortable questions with the kind of urgency you only hear when people suspect there's more behind the curtain than they're being told. How connected are the exchange and that trading firm? How much collateral is tied to the token? If prices fall, who gets margin called? And if margin calls begin, where does liquidity come from? Because here's the part that people forget about exchanges. An exchange can look gigantic and still be fragile. It can appear liquid while confidence is intact, because customers are not rushing for exits at the same time. But when an exit rush begins, exchanges don't get to control the flow. The crowd does. And the crowd is faster than any risk department. Around this moment, a public statement from the leader of a rival exchange lit the fuse. He indicated that his firm intended to sell its holdings of the exchange's token. The stated reason was risk management and lessons learned from past failures. The market heard something else. The market heard that one of the biggest players had decided it didn't want to be anywhere near the building if a fire started. That single signal changed the emotional temperature of the entire ecosystem. Because traders understand this principle in their bones. When smart money runs, it's never jogging, it's always sprinting. Withdrawals began to accelerate. At first, it looked like the kind of routine stress exchanges claim to handle. High volume, a bit of congestion, a few delays. Then it started looking like something else. Customers reported transactions pending longer than usual. Some began to see withdrawal requests stuck. Others started posting screenshots that implied the pipes were slowing down. This is where modern financial panic becomes uniquely dangerous. In traditional banking, a run can still be limited by physical friction. People have to move. Branches have lines. There are bottlenecks. In digital finance, there is no line. There is only refresh. And refresh is instant. Once social platforms began filling with reports, the story started feeding itself. One person posts a delay, another person sees it and panics. 10,000 people see that and decide they are not going to be the last one out. That is not fear. That is math. Because in any run, the only irrational choice is waiting. Behind the scenes, the exchange attempted to reassure the market. Public comments suggested that assets were fine, that everything was normal, that there was no issue with solvency. But the problem with reassurance in a bank run is that it rarely works. Not because reassurance is always false, but because the crowd understands that even a healthy institution can be destroyed by a liquidity event. Solvency and liquidity are different. You can be solvent on paper and still fail if you cannot meet withdrawals in real time. And by this point, traders were no longer debating solvency as a concept. They were watching liquidity as a behavior. The next headline hit like a gut punch. A deal was being discussed for a competitor to step in and acquire the exchange, pending due diligence. For a moment, the market froze because the implications were enormous. If a rescue deal was needed, things were worse than people thought. If a rescue deal failed, things were far worse. And if a rescue deal was even being considered, then the exchange had crossed from being a confident institution to being a distressed one. That transition is almost impossible to reverse. The industry watched the situation unfold in hours, not weeks. This is one of the defining features of crypto crises. The timescale is brutally compressed. In traditional finance, rumors can take days to crystallize into action. Committees meet, risk teams negotiate, regulators intervene, banks coordinate. In crypto, the market moves at the speed of its own anxiety. By the next day, the deal collapsed. The acquiring exchange backed away after reviewing information it did not like, citing concerns about handling customer funds and potential regulatory issues. Now the story had no oxygen left, because the narrative had changed from "there is a rumor" to "there is a run" to "there is a possible rescue" to "the rescue refused." When that happens, the crowd stops asking questions. The crowd only exits. Withdrawals were halted. And that is the moment when trust doesn't just weaken, it snaps. If you have never experienced an exchange halt during a panic, it is difficult to explain how quickly the mind switches from concern to certainty. People don't think. Maybe they're pausing withdrawals. People think the money is not there. Because if the money is there, the one thing you do not do is lock the doors when everyone is trying to leave. Within days, the collapse was no longer a rumor or a run. It became a legal event. The exchange group filed for bankruptcy protection. Senior leadership stepped down. A restructuring professional was brought in, and public statements from new management described severe failures of internal controls and corporate governance. Those are formal words, but in market language, they mean one thing. This wasn't a miscalculation. It was a breakdown. And once the market accepted that, the damage spread outward like a shockwave. Because the platform wasn't just a trading venue, it was connected. Funds used it. Firms held assets there. Market makers depended on it for liquidity. Projects kept treasuries on it. Individuals kept life savings on it, not because they were careless, but because they believed the brand meant safety. In the days that followed, the contagion became visible. Other companies paused withdrawals, lenders tightened terms, counterparties reassessed exposure. Prices fell hard, not simply because people were selling, but because the market was repricing trust. This is a concept most traders learn late. A market can price risk, but it can also price legitimacy. And when legitimacy collapses, the repricing is violent. Major cryptocurrencies dropped. Large tokens sank. Assets tied to firms exposed to the exchange sold off aggressively. Liquidity thinned. Spreads widened. It wasn't just a bear market move, it was a confidence event. The difference matters. Bear markets are slow erosion. Confidence events are cliffs. Behind every chart candle, there were human scenes repeating across the world. People waking up at 3 a.m. to check withdrawals. People refreshing dashboards while group chats filled with panic. People negotiating with themselves, trying to decide whether to accept a loss by selling or to hold in hope, even though hope isn't a liquidity strategy. There were traders who lost money in the market, and there were customers who realized they weren't trading at all. They were unsecured creditors. This is the part that turns a price story into a trauma story. Because a trader expects to lose on a bad position. A customer does not expect to lose access to their own assets. Not like that, not overnight. And once that lesson is learned, it changes behavior for years. It changes where people hold funds. It changes which platforms they trust. It changes how they interpret marketing. It changes how they read headlines. It changes how they think about the entire industry. The collapse also did something else. It made the world pay attention. Regulators intensified scrutiny. Investigations accelerated. Court proceedings revealed new details. Public discussion shifted from innovation and adoption to custody, controls, and accountability. Crypto had always argued that it was building a new financial system. The collapse forced the simplest question. If this is a new financial system, where were the safeguards? Because in any system that holds billions in customer assets, the core promise must be boring. Not revolutionary, boring. Segregation of funds, clear risk controls, auditable books, transparent governance, the unglamorous architecture of trust. The industry realized painfully that trust cannot be sponsored into existence. It cannot be purchased with naming rights. It cannot be produced by celebrity endorsements. Trust is built in back offices, in reconciliations, in controls that no one posts screenshots of. And when those controls are missing, trust does not fade, it collapses. Overnight, here's the tonic. A market crash is terrifying, but it's still a market event. An exchange collapse is something else entirely because it breaks the one assumption that makes trading possible. That when you hit withdraw, the system will respond. It wasn't the first platform to fail, but it was different because it looked like the one that wasn't supposed to. It looked like the adult in the room. It looked like the bridge between crypto and traditional finance. And when that bridge collapsed, the industry didn't just lose money. It lost credibility, and credibility, once broken, is the slowest asset in the world to rebuild. Because after that week, every trader carried the same quiet thought into every new position, every new platform, every new headline. Not what will price do, but can I trust the place holding my money? That question doesn't show up on charts, but it shapes every chart that comes after.